The tool that once saved the dollar can't be used again. That sounds impossible, but that's exactly where we are. In 1980, the Federal Reserve crushed inflation with brutal interest rates. The pain was real, but the system survived. Today, inflation is back, but the weapon that stopped it last time is off the table. Here's the contradiction no one wants to say clearly. To fight inflation, rates must rise. But if rates rise too far, the system breaks. And this isn't some abstract Wall Street problem. This lands directly on you, your savings, your paycheck, the cost of food, housing, energy. The value of every dollar you hold quietly depends on a decision that may no longer be possible to make. Markets still talk like history can repeat itself, like the old solution is just waiting to be reused. But what if it isn't? What if the system is now too leveraged, too indebted, too fragile to survive the cure it once relied on? What if the fight against inflation is no longer about stopping prices, but choosing which kind of damage comes next? Because once that option disappears, everything else starts to behave differently. And that's where this story actually begins. The story officially starts with a moment most people think they already understand. Inflation is high, central banks raise rates, and eventually prices cool. That's the familiar script. But this time, the sequence is breaking. The core event isn't just inflation itself. It's the assumption that the system still has the freedom to fight it. Rates have already been raised, but not to levels that historically stop inflation in its tracks. And that's not hesitation, that's constraint. Notice the pattern forming. Each rate hike triggers stress somewhere else, in government budgets, in debt markets, in housing, in banking. Instead of tightening confidence, higher rates now expose fragility. So policymakers slow down, they pause, they signal flexibility. Here's the question that reframes everything. If inflation requires higher rates to stop and higher rates threaten the system, which one do you think gets sacrificed? This isn't a single bad decision, it's a structural loop. The more debt the system carries, the less pressure it can tolerate. And the less pressure it can tolerate, the longer inflation lingers. That dynamic didn't exist in the past. It does now. And once markets realize that the ceiling on rates is real, not theoretical, behavior starts to change fast. Because expectations matter more than announcements. And expectations are already shifting. There's a claim hiding in plain sight that changes how this entire situation should be read. Inflation isn't stubborn because policymakers lack discipline. It's stubborn because the system can't afford discipline anymore. Look at the numbers that quietly define the boundary. Government debt is no longer a side issue. It dominates everything. The interest cost alone has climbed into territory that rivals and in some cases exceeds major categories of public spending. Every additional percentage point in rates doesn't just slow the economy, it detonates the budget. That's why the reaction function has flipped. In the past, inflation dictated policy. Now debt does. The moment rates rise too fast, the conversation stops being about prices and starts being about solvency. And that's not theoretical. You can see it in how quickly the tone changes after each tightening cycle. 1 hike, confidence; 2 hikes, concern; 3 hikes, emergency meetings. Notice what's missing from official messaging. No one commits to keeping rates high for as long as it takes. That phrase used to anchor expectations. Now it's carefully avoided. Instead, you hear words like data-dependent and balanced risks. That absence matters, because markets don't wait for collapse. They front-run constraints. Once investors sense that rates can't rise indefinitely, they stop behaving as if inflation will be crushed. They start positioning for something else. And when that shift happens, price signals across the entire system begin to distort at the same time. What happens next is escalation, not resolution. Because once the system hits its tolerance limit, every attempt to restore order creates a new instability somewhere else. There's a historical parallel people keep reaching for: but it no longer fits. In earlier cycles, tightening policy caused pain, then reset behavior. Inflation broke, confidence returned. This time, tightening doesn't cleanse the system. It exposes how dependent the system has become on cheap money just to function. Watch how abnormal conditions start to feel normal. Massive interest costs are treated like background noise. Emergency measures are rebranded as tools. Temporary support quietly becomes permanent. None of this triggers alarms anymore, it's absorbed. And that's the escalation, not a single dramatic event, but a slow normalization of fragility. The system keeps moving, but only by narrowing its own options. Each policy choice solves the immediate problem while shrinking the range of future responses. Here's where the story flips. The question is no longer will inflation come down. The real question becomes what must be sacrificed to keep the system intact. Because once stability depends on avoiding discomfort rather than enforcing discipline, outcomes start to drift. And drift in financial systems is never neutral. It always moves wealth, power, and risk in one direction. And that direction is already starting to show. The next proof point is stronger and it's harder to ignore. Because what leaders say and what the system actually does are now moving in opposite directions. Publicly, the message is about fighting inflation, staying vigilant, maintaining credibility. But behind the language, the actions tell a different story. Rates rise, then hesitation sets in, balance sheets tighten, then exceptions appear, stress emerges, and suddenly stability becomes the priority again. This is the contradiction that changes how you should read every headline. Inflation is treated as dangerous in speeches, but systemic stress is treated as intolerable in practice. And when those two collide, one always wins. You can see it in the sequencing. Pressure builds, markets wobble, liquidity gets tight, and instead of pushing through, the system blinks. Support is extended, timelines shift, expectations are managed downward. The fight quietly softens. Here's the line that permanently reframes this. Inflation is no longer the crisis. Losing control is. Once you see that, market behavior starts to make sense. Assets don't respond to promises, they respond to limits. And the limit is no longer political will, it's mathematical. That realization forces capital to reposition, not based on optimism or fear, but on survival logic. And when survival becomes the organizing principle, volatility isn't the risk. Repricing is, because the system can't say this out loud, but it's already acting on it. Now the pressure starts stacking, fast, not as one crisis, but as several smaller ones that arrive too close together to isolate. First, higher rates squeeze government financing, budgets tighten, deficits widen, every rollover becomes more expensive. That alone would be manageable if it were happening in isolation. At the same time, higher rates strain credit markets. Borrowing slows, refinancing gets harder, weak balance sheets surface. Suddenly what looked stable under low rates starts to wobble. Then comes the third layer. Asset markets react, not with a clean reset, but with uneven stress. Some assets surge, others freeze. Liquidity thins out in places no one expected, and when liquidity disappears, confidence follows it. Notice how fast the language changes during these moments. Words like contained and transitory are replaced with monitoring and prepared to act. That shift isn't reassurance, it's signal. The system isn't breaking all at once, it's losing coordination. And loss of coordination is more dangerous than collapse, because it forces constant intervention just to keep things moving. Here's the question that hangs over everything now. What happens if this continues? Because each response buys time, but costs flexibility. And time without flexibility doesn't resolve pressure. It concentrates it, and the point of release is getting closer. At this point, the consequences stop being abstract. They show up in ordinary decisions you make without thinking about macroeconomics at all. You feel it when savings don't seem to go as far, even when the numbers look higher. When raises exist on paper but still fall behind daily expenses. When housing feels permanently out of reach, not because demand vanished, but because financing never really normalized. This isn't a crash, it's a squeeze. And that's why this environment is so disorienting. Nothing is obviously broken, jobs still exist, markets still function, but the margin for error disappears. One surprise expense matters more. One missed paycheck matters more. Planning stops being about growth and starts being about endurance. This is how inflation actually hurts people, not through headlines, but through uncertainty. You delay decisions, you hesitate, you lower expectations quietly, and over time, that changes behavior across an entire society. Notice what's missing from the conversation around you. No one talks about stability anymore. They talk about adaptation, coping, flexibility. Those are survival words, not prosperity words. If this feels familiar, say so in the comments, because when millions of people start adjusting downward at the same time, the system absorbs it silently, and that silence is often mistaken for resilience. It isn't. It's pressure being redistributed onto you. To understand why this keeps happening, you have to look past individual decisions and into the machinery itself. Systems don't behave according to intentions, they behave according to incentives. Right now, the incentive structure is clear. Debt must be serviced, markets must remain calm, confidence must be maintained. Everything else becomes secondary. That's how leverage quietly takes control, not through force but through necessity. Spectacle plays a role too. As long as prices rise somewhere, the system can point and say things are working. Asset gains become proof of stability, even when they're driven by the same pressures causing the instability. That illusion buys time, and time becomes the most valuable currency of all. Fear is the final lever, not panic-managed fear. Just enough stress to justify intervention, just enough uncertainty to discourage resistance. Over time, people stop asking why the system feels unstable and start asking how to live inside it. Here's the unsettling insight. This isn't a failure of policy. It's the logical outcome of a system that traded resilience for speed and discipline for scale. Once it crosses that threshold, it can't simply reverse. It can only manage the descent. That's why the story never resolves cleanly. It mutates, it stretches, it adapts, and each adaptation makes the next one harder. Which brings us to what happens next, because momentum hasn't slowed. It's changing direction. From here, the path splits, but neither option is clean. One direction looks calmer on the surface, pressure is managed, rates are capped, liquidity returns when needed, inflation drifts lower but never disappears. The system keeps moving, just slower, heavier, and more fragile. In this path, nothing breaks dramatically, but purchasing power keeps leaking. Quietly, persistently, you don't notice it day to day, you notice it year to year. The other direction is sharper. Something forces the issue. A shock, a miscalculation, a loss of confidence that can't be smoothed over quickly. In that path, policymakers are pushed to choose between defending the currency or defending the system. And once that choice is made, it's visible, markets reprice fast, assumptions reset, volatility spikes, not because people panic, but because clarity finally arrives. Neither outcome restores the old normal. Both move forward from where the system actually is, not where it wishes it were. What matters now is momentum. Expectations are adjusting in real time. Capital is repositioning before decisions are announced. The next move doesn't arrive as a surprise. It forms gradually, then appears obvious in hindsight. And the signs aren't hidden. They're already emerging if you know where to look. Here's the insight that ties everything together. This isn't a story about inflation or rates or markets in isolation. It's a story about limits. The limit of leverage, the limit of control, the limit of repeating solutions that only worked under conditions that no longer exist. Once a system reaches that point, outcomes stop being managed and start being revealed. Prices don't just reflect value anymore, they reflect constraint. Every distortion you see is a message about what the system can no longer afford to do. That's why nothing feels stable, even when nothing is collapsing. The instability isn't loud, it's structural. And structural problems don't announce themselves. They show up as tension that never fully releases. The real shift happens when people stop asking, when does this end? And start asking, what does this environment reward? Because that question changes behavior long before headlines do. This story isn't finished. It can't be. Systems like this don't conclude. They transition. And the next phase is already forming out of the decisions being made right now. If you want to stay ahead of that transition, follow, subscribe, and stay with this analysis.